If you search online right now for cash-on-cash returns on a Kansas City rental, you're going to hit a massive wall of marketing pro formas promising you incredible double-digit returns. They look absolutely phenomenal on a PDF, right? But let's be honest, it can be incredibly frustrating trying to separate that glossy marketing fantasy from the ground-level truth. So today, we're pushing the glossy marketing aside. We're doing a completely data-driven teardown to show you the true 2026 reality of investing in Kansas City real estate. Let's get into the actual numbers.
Now, before we get into the heavy math, a quick heads up. This explainer is strictly a practical underwriting guide. It's an educational tool designed specifically to help you, the focused investor, understand the precise math behind a real estate deal. Please keep in mind that this should not be taken as legal or tax advice. We are simply here to talk strategy and math.
Here is our roadmap for today. 1. The pro forma myth. 2. A real 2026 case study. 3. Total cash invested. 4. Line-by-line reality. 5. Hidden operating expenses. And 6. The total return picture. Let's dive in.
Section 1. The pro forma myth. Let's establish a solid baseline so we're all on the exact same page. What is cash-on-cash return? Well, it's simply your annual cash flow before taxes divided by the total cash you actually put into the deal. In everyday terms, for every dollar you invested, how many cents landed in your pocket this year? It's a very specific metric, and it's entirely different from cap rate or total return because it focuses strictly on the efficiency of the actual cash you deployed today, not the total value of the asset. Knowing this distinction is exactly how you avoid getting misled by inflated marketing numbers.
The core problem you face as an investor today is that the optimistic marketing pro forma assumes a flawless world. It literally assumes zero vacancy and completely ignores capital reserves. Contrast that fantasy with real underwriting from Alpine Property Management, Kansas City. Since 2013, Alpine has modeled a realistic scenario that fully reserves for expenses. They have managed these assets through every kind of market cycle you can imagine. And let me tell you, only one of these methods actually protects your capital when a water heater breaks at 2 in the morning on a holiday weekend.
Section 2. A real 2026 case study. To really ground our data today, let's look at a specific asset. This is a real 2026 case study in Independence, Missouri. We're looking at a Class C, 3-bedroom, 1-bathroom, single-family home. The purchase price is $135,000, and it pulls in $1,425 in monthly rent. That gives us a remarkably strong rent-to-price ratio just above 1%. This is exactly why the Independence submarket specifically attracts so many out-of-state buyers. It offers a very compelling balance of acquisition cost and strong rental demand from working-class tenants. Plus, this specific property is essentially rent-ready after a modest turn.
Section 3. Total cash invested.
The absolutely crucial starting point is figuring out exactly how much cash you need to close and stabilize this property. Your total cash invested is roughly $42,600. That breaks down into a 25% down payment of $33,750, closing costs of $4,100, an initial make-ready turn of $4,000, and an Alpine lease-up fee of $713. Pay very close attention to those last two items. Competitor pro formas routinely omit the make-ready turn and the lease-up fee to make the initial math look far better than it actually is. But those are real, hard dollars that leave your account before your very first rent check ever arrives. You have to account for them.
Now let's talk about the debt. Out-of-state investors heavily rely on DSCR loans, which qualify the property on its own cash flow rather than your personal W-2 income. In 2026, a realistic 30-year DSCR rate for this deal is 7.0%. That creates an annual debt service of about $8,083. At today's rates, debt service is the absolute heaviest line item on your property ledger. You need to understand that a single percentage point swing in your interest rate can literally be the difference between a highly profitable year and a year where you simply break even.
Section 4. Line-by-line reality. Let's dive into a direct side-by-side comparison. On one hand, we have the optimistic marketing pro forma showing a beautiful 10.3% return. On the other hand, the real Alpine numbers showing a 4.1% return. Both start with $17,100 in gross rent, but honestly, that is where the similarities completely end. The marketing pro forma assumes zero vacancy, a stale tax figure, thin insurance, a discounted management rate, and zero capital reserves. Alpine, however, accounts for a realistic 4% vacancy rate, current taxes at $1,900, proper insurance, their actual 10% management tier, and 4% for capital reserves. Here's the massive takeaway for you. Optimism compounds. By ignoring reality, the marketing flyer artificially erases more than $2,600 of expenses that you will absolutely have to pay out of your own pocket.
Section 5. Hidden operating expenses.
Out-of-state buyers consistently underestimate 3 specific line items when looking at the Midwest. The most dangerous one by far is capital reserves, which Alpine diligently budgets at 4%. Look, roofs, furnaces, and water heaters do not fail monthly, so marketing flyers conveniently just leave them out of the equation. But a single sewer lateral issue in Independence can cost up to $12,000. Skipping this reserve line is exactly how a profitable spreadsheet turns into a completely broke reality. You also absolutely must account for routine vacancy turnover costs and inevitable property tax reassessments as local values rise.
Speaking of taxes, Missouri assesses residential real property at 19% of market value. This is a crucial state-level difference from neighboring Kansas that catches so many investors completely off guard. On our $135,000 Independence property, that 19% assessment ratio, combined with the local levy, produces a very real tax bill of approximately $1,900 per year. You simply cannot manage fixed costs away. That is exacted why Alpine Property Management Kansas City underwrites them at current, realistic levels rather than relying on historical seller levels that are bound to jump up right after you close.
Section 6. The total return picture.
Okay, we have looked at the hard expenses. So we arrive at the most critical question of this entire explainer. Is a 4.1% cash-on-cash return actually a successful investment in Kansas City at 2026 interest rates? Take a second to really think about that. By itself, 4% sounds quite modest. Any honest property manager will tell you that straight up. But cash-on-cash is only one single slice of the return. Let's reframe the financial picture to look at how long-term wealth is really built in real estate.
To really answer that question, we have to look at the full financial engine of real estate. Step 1 is your cash flow, which we conservatively calculated at $1,731. But then we stack Step 2, which is loan paydown. This is essentially a forced savings account. Your tenant is actively paying down your mortgage for you, adding roughly $1,050 in principal reduction this year alone. Finally, we stack Step 3, which is appreciation. Even at a highly conservative 2% growth rate on a $135,000 home, you are gaining about $2,700 in invisible equity growth.
When you stack the real cash flow, the tenant-funded loan paydown, and the conservative appreciation all together, the true total first-year return lands at a highly respectable 12 to 13% on your $42,600 invested. This is the honest, fully transparent way to frame a Kansas City rental in 2026. You might see thin current cash flow in year 1, but there is a real, powerful wealth-building engine operating underneath it all. As rents naturally rise over time and your loan balance steadily shrinks, that overall return is only going to improve. The investors who truly win in this market are the ones who buy right, reserve honestly, and hold for the long term.
So, the final question you have to ask yourself is this. When the unexpected happens, and trust me, it always does, will your spreadsheet protect you? Are you underwriting your next real estate deal the real way or the pretty way? Do not let a glossy pro forma cost you thousands of dollars in surprise expenses. For help managing your Kansas City rental property, call Alpine at 816-343-4520 or visit alpinekansascity.com.